They've spent it along the way, and then the usual amount that's available to pay some bills that maybe had piled up or trips or what have you this time of year, that number's not there. So
well, I
understand what you're saying, but it still doesn't help that people feel like they weren't prepared for this. So was there any way that
the Treasury technical staff is sort of disputing some of these stories, and so I haven't really dug into the weeds about whether in the fullness of time
well, I can
we're
tell you
going to see smaller refunds.
In our zip code, I'm sitting around the pod and I'm hearing stories of one guy's refund was half of what it used to be. One went from getting a refund to owing money.
So the question is, would you rather have your money now or a year from now, right? You would rather have your money now.
Yeah, they're not furious, but it's an inconvenience, and for some people, it's a pretty big one.
Well, sure, and we'll follow the thing closely, but it's really, really early in the season, and we'll have to wait and see. I mean, most people are going to be filing in April, and so again, the Treasury staff, I think, they've disputed to me some of the accounts we've seen out there of that issue.
We want to get to trade. We want to get to the possibility of auto tariffs on Europe, but I want to come back to something you said a moment ago, and that was that the capital spending that went into the economy in the form of factories built or expanded last year is going to produce output this year. Give me the numbers, because I think there is some suspicion that some of the money that derived from corporate tax cuts really didn't go as much as we would have wanted into capital spending, but rather went into buybacks, and that has been a criticism of the 2017 tax law. Take us through the numbers on capital spending versus buybacks.
Yeah, thanks for that question. You know, I love the numbers. So the fact is, if we go back to the fourth quarter when the tax cuts were passed, then the cost to capital, which is the key number people look at when they're deciding whether to build factories and buy machines, was going to drop, we said at CEA, by about 9% in 2018, which we said would make capital spending go up by about 9%, because you see about a one-to-one response. With the numbers that we have through the third quarter, counting the fourth quarter surge in equipment, which was retroactive, and so you should count that for the tax cuts, then we have total capital spending up 8% last year. And so it's almost exactly what the model said. And now that 8% increase is going to produce output this year.